Welcome to Life Lessons. If you're here to learn about life insurance, you've come to the right place. Today we're going to answer the question, how much is your life worth? Yeah, that's a pretty big existential question. I'm not sure I'm qualified to answer it for you. But from a more pragmatic financial standpoint, I can share a few strategies to help you come up with an answer. If you remember lesson 1, life insurance is simply a contract between you and an insurance carrier whereby they agree to cover you for the risk of financial loss your family would suffer if you die. In order to know how much coverage you should have, you need to have a way to measure that potential loss. I'll start by saying that no technique is going to give you a perfect answer. We're talking about a future risk, so any answer we come up with is going to be flavored by the assumptions we make about the future. Things like inflation, your future earnings potential, future spending habits, the rate you'll earn on your savings and investments, all of these can impact the outcome of the process. This is why it's important to review your coverage regularly and adjust it to compensate for any changes in your situation or your assumptions about the future. That being said, let's dive in. The first thing we'll look at is what's called final expenses. This is a category that includes all of the costs of dying. That might include funeral costs, a cemetery plot, outstanding medical bills, attorney or probate fees, possibly taxes. The average funeral alone costs about $12,500, and the other listed costs can vary greatly depending on your financial situation and how much planning you've done. Next on the list is debt liquidation. Debt is simply a way of trading your future financial earning power for something that you want to buy today. If you lose that future earning potential because of your death, it makes sense to plan to liquidate that debt. Here we're talking about credit card debt, auto or student loans, lines of credit, and other revolving credit. Next, it's good to establish an emergency fund. It's good to have one anyway, even while you're living, and most financial advisors recommend keeping between 3 and 6 months worth of your basic living expenses in a liquid account. While you're healthy and working, maybe you have options to get by if you haven't established this account, but after you're gone, it will be even more difficult for those you left behind. So add 6 months of your basic living expenses to the total. The next category is your mortgage or rent. Losing a loved one is a major life stressor. Being required to move because your family can no longer afford your home just piles on more stress. By leaving enough benefits to either liquidate the mortgage or to pay rent for a certain period of time, you can ensure that your family can stay put and only have to deal with one life change at a time. Next is child care. If you're contributing to the care of your children, you may want to establish a fund to cover having to pay someone else for those services. And speaking of children, are you currently contributing to an education fund for them? If you die before you complete your contributions, consider making sure your life insurance can complete the plan for you. Finally, the last piece is income replacement. Most two-income households will still need about 80% of the combined household income if one of the wage earners dies. If you're providing the only income, that percentage could be higher. Most often, you'll want to provide enough benefit to replace your income until what would have been your retirement age. This can be calculated by any qualified life insurance professional. And that's it. If you want to see for yourself how this calculation works, feel free to try out our life insurance calculator at www.cfg4u.com or get in touch and we'll be happy to put you in touch with a qualified agent.